Hi, I'm Keith McCullough. Welcome back. Today with the U.S. stock market at its all-time highs, and as you know, all-time is indeed a long time, we want to talk about the long-term strategy from here. How do you make decisions from a long-term perspective from these prices? To answer that question, we always focus on two really big factors from an investment perspective, which are, of course, growth and inflation. So let's get into that. The first thing that we tend to focus on when you think about growth and inflation is the direction or the slope or the rate of change. So again, we're trying to figure out whether growth is accelerating or it's slowing. We're trying to figure out whether inflation is accelerating or it's deflating or it's falling. So again, if you can figure those things out, you can really start to answer the first question in risk management, which is, of course, how not to lose money. That's how you preserve wealth, by the way. You don't buy things that can go down 10, 20, 30%. And when you start thinking about it like something like the stock market at its all-time high, you have to be very, very careful about that in terms of buying too high. So again, let's start with what not to do. Now, last year, the point number one would be we had growth accelerating. So in a growth accelerating environment, what not to do is pretty straightforward. Don't short high short interest stocks, high beta stocks, high growth stocks that actually beat expectations. Because in a growth accelerating environment, people pay a very high multiple for stocks. Now that's basically been the last 15 months of investing. So again, lesson learned. Hopefully you didn't do any of that in terms of shorting those things. And of course, if you don't short stocks, the opposite of that statement is don't sell them or buy and hold them. It's easier to make money when those factors are working in your favor. Now, when inflation's accelerating, which is the second scenario that I'd like to discuss, which is basically what we have right now, you don't short commodities, you don't short gold, you don't short natural gas, you don't short coffee prices. Again, start with what could hurt you. Again, don't do that. And if you want, buy and hold that stuff, and obviously that stuff could work for you too. So again, in inflation accelerating, very easy exposures to understand. Now, thirdly, what happens when inflation's accelerating and growth is slowing? So again, we would submit that if you get too much inflation, the consumer starts to slow. So again, very simple setup. Dollar goes down, inflation goes up, and at the end of the day, real consumption growth starts to slow. So don't short bonds, don't short utilities, don't short basically gold again. So if you think about those, why do those things work when inflation's accelerating and growth is slowing? Because people are looking for slow growth investment vehicles where they can hunker down and be safe. And that's precisely what you've seen in the stock market for the year to date. While the S&P 500 may very well be making a new all-time high today, it's flat for the year to date, whereas utilities are up about 7.5%. Gold's up more than that. It's up almost 11%. And again, utilities and gold aren't coming off of their all-time highs. They're coming off the lows when growth was accelerating. So again, we're basically telling you to do almost the exact opposite of what we would have told you to do 15 months ago, because again, the two big factors have changed. Instead of inflation falling, it's rising. As inflation rises, growth slows. Again, very much the textbook that we work with. Now, just to hit on three quick charts on things that would change my mind. Obviously, I have to think about that all day long. If you're going to think about what not to do or how not to lose money, you always have to think about that. Of course I think about that. Where am I going to be wrong? So the first one would be the dollar. Now, the dollar, of course, I'm not wrong on that today. I wasn't wrong on that last week, and I haven't been wrong on that really for 3 months. The dollar has been very, very weak. So again, the dollar being weak, if that were to reverse and we were to see dollar strength like we did into the second and third quarter of last year, I could change my mind, particularly if it would lead to the next chart, which is commodities. Now, commodities, as you can see, for the year to date, just had their best week actually last week, up 2.8% last week to up almost 8% for the year to date. And by the way, as the market pushes to new highs today, it's what's leading the market higher. Gold is up more than the S&P 500 or thereabouts for the day. So again, if inflation is rising, I'm not going to get out of the way on this. This is very 2011. At the beginning of 2011, utilities and gold started to break out. The dollar started to weaken. People were kind of wondering what to do with the stock market. But again, you got to understand what underneath the hood in the stock market is driving the highs. Now, finally, consumer prices, which are kind of a derivative of commodities, but the CPI has things in it that are going straight up, like rent. If you don't know if rent's going up, then move to California and tell me how that goes. So again, CPI just went from 0.9% to 1.6%. Now that was reported last week, and a lot of people will say, hey Keith, 1.6%, it's not going to concern the Fed. I don't care about that. What I care about is consumption. So again, in the real world, if inflation doubles, which I think it will this year, in other words, it's going to go from its October 2013 low of 0.9% to something around 2%, and growth gets cut in half from 4.12% in the third quarter of last year to 2 something, that's going to be very bad in terms of how I think about growth again. Growth slows as inflation accelerates. So those are how we're really kind of looking at and around the kinds of things that could go against us and or change, and currently they're not changing today. So with that, that's how I'm thinking about today in terms of the longer term. And again, the longer term cannot be a good longer term if in fact inflation is accelerating and people are forced to chase that. I'm at Keith McCullough. If you have any questions, please ping me. That's my Twitter handle.